Hey, what's up guys, Michael here. In today's video I will be talking about the ATR indicator and how to use it, how to identify the trend reversals using the ATR, how to identify the bigger breakouts, bigger moves using the ATR, and how to set a stop loss using the ATR, and as well maybe how to write bigger moves, how to write bigger trends without being stopped out on a minor retracement. So maybe let's log into our account and open some charts. For example, let's use the GDP USD. Let's add the ATR on our chart. It is for free, I think, in every platform, so you shouldn't have problem with finding it and with the availability. So let's add it on our chart, and it is down below. So basically ATR measures the volatility on the market, which means, as you know, most probably, that the market is moving in waves. There are parts when the market has the high volatility, where there is a big changes, big price changes on the market, and there are times when the market is, we can say, sleepy, moving sideways, etc., with the smaller volatility, when the range between the prices is very small. So the market moves from between those periods, and the ATR will help us to determine those moments. So how it works basically, maybe let's illustrate it on a chart. Okay, so we have example here. We see that in this moment there were big candles, there were bigger candles with big notches, small bodies, it doesn't matter, but the price change during the formation of those candles were higher. I have on me in this period, and as you can see, the ATR were rising, right? The candles were bigger, the volatility was bigger, so as well the ATR was rising. When the volatility started to shrink, to getting smaller, so as you can see here we have smaller candles compared to the previous one. Maybe let's also mark it on the ATR. And the moment, and this moment when the volatility was starting to getting smaller, the candles were getting smaller, so as well as the ATR started to fall significantly. So basically, as you can see, it measures the volatility. The calculation for the ATR is more or less in simple terms as follows. It is deduction from the current high, the current low, and it measures the last, for example, 14 periods. It depends on the settings you choose, and of course it divides them by 14. So for example, it takes the current high minus current low from this candle, the high, and the high from this candle deducts the low from its candle, and it measures in this way the last 14 candles and divides that by 14. And basically it is we can say simple moving average from the volatility. The settings you can choose by clicking on this cog, and it is the default settings, which is the 14. So basically that is how you should understand the ATR. And now let's look for the moments when we can determine the breakout moves. Maybe let's choose gold chart. Let's delete the volume indicator and the ATR. And to determine those moments, we will use the weekly time frame, which is the best because we are looking for multi-year low volatility to determine moments when the market could break out. So let's stretch the chart a bit. Okay, and we see that, for example, the volatility during this period was getting lower and lower, and here we had a multi-year from the 2008, from the half of the year of 2008, the record low volatility. So in May 2019 we had the lowest volatility since almost 10 years, we can say. So since more than 10 years. So basically, we in this moment we should be wary that there is a low volatility, and we should look for the market structure to determine the moments where the price could break out in either direction. So if we have such a move, what we need to do, of course, is to determine the support and resistance levels. So we have the first one, for example, here. The second, for example, here. So after determining the support and resistance levels, what we should look for next are the candlestick chart patterns. So, and of course, at the breakout points, which are these moments right here when we were on those support and resistance levels, the key levels. As you can see, it is not the perfect solution, but hey, there are no holy grails, so we would need to look for a good opportunity. And here, for example, we would have the three white soldiers candlestick chart pattern with the breaking point, with the breaking of this resistance level. Then we would have the strong green with big body candle, and therefore the doji. For example, if we would zoom out on a daily time frame, or in even for H4 time frame, we would see some flag or maybe a wedge that would suggest as the continuation, and therefore we are looking for the bigger moves when you see right here when the volatility change starts to rise, and therefore it was a bigger move to catch. So basically, that is how you should look at the volatility on the ATR. Look for the multi-year lows, and therefore look for the market structure and the breaking points and the confirmations. So the next thing to talk about is the reversal moments. So basically, the concept is that when the price moves 1.5 times the ATR and it stays on a resistance or support level, and we will get the signal from, for example, the candlestick chart pattern for a reversal, that would suggest us that the market will reverse at this moment. And here we had this situation. We have this very strong red candle. I mean this one here, and the price change was around, it is $71.3 for better calculation, and 65.6 more or less. So it was around $4 price change. We can round it up, and the ATR at this moment was $2.25 even cents. We can also round it up for better calculation. So it was 2x the ATR. So let's check other signals. So where we are on the chart, we can clearly see that we are on this very strong support level, which was created by those zones over here and here. We try to break through a couple times, 1, 2, and on the third attempt it went. So this is a very strong resistance. It was and now became a support. And what we have next, let's delete this rectangle, and what we have next is the doji candle, which could suggest us that the price will reverse. So basically that is the concept of how to use the ATR for the reversals, which is the 1.5. The price change needs to be 1.5 times the ATR. So in this situation, it is, we can say, even a textbook. And let's switch to lower time frame to see if we had some other confirmation from the candlestick chart patterns. So we are here on this support, and here we had the swing high candlestick chart pattern, where we had these are two red candles with the green engulfing the two previous candles bodies. And even further, we have the three white soldiers candlestick chart pattern, which could be additional confirmation for us. So that is basically the concept of using the ATR, how to determine the moments. So we were looking for 0.5 the ATR, the price change, 0.5 the ATR, and then we look where we are on the chart and the market structure, and then look for the additional confirmation in the candlestick chart patterns. So that's the other usage of the ATR. And now we will be talking about how to set a stop loss using the ATR. But let's look for other example which would be better visible how to use the ATR with determining the stop loss level. Okay, so right now let's talk about how to use the ATR to determine the stop loss level. So we have the Euro Pound chart. This is the daily time frame, and let's zoom out and, for example, check this scenario while we have this resistance level over here, resistance zone. We can mark it with the line. It would be somewhere over here, right? And for example, I was looking at here because it was a good example for showing you why it is a useful tool, this ATR, to determine the stop loss. So basically we have situation like right here when we have the support level, and we see again the swing high bullish engulfing candle to the previous two candles, therefore signaling us that the upside move might occur. So therefore, what we are doing in this situation, we are entering more or less in the retracement, in the half of the retracement of this whole formation. So more or less we are entering somewhere over here. That would be our perfect entry. Let's maybe mark it with a different color. So what we could do, we could make it more green and thicker. Okay, so that would be our entry level, and the most likely most of the traders stop loss would put somewhere over here, just below the formation, maybe at a pips or two, and yeah, in this situation you would be stopped out before the bigger move. So right here the ATR comes in hand because we are therefore checking what was the value over here when we were entering the market. It was 59, and we just multiply that by 2 and adding at before the market structure, so before our potential stop loss levels. So right here, let's see, range of prices, and we have this level here. So 59 multiplied by 2, it is 118, right? 118, okay, more or less. So as you can see, this downward move would not stop us out of the position. And if we would use the 2R risk reward ratio, therefore how much it would be from our entry point, 183 pips, so it would be 366 points, 366 points. So this particular example would be profitable, but as you can see, this is a cherry-picked example, so you could see and understand what I have on me, how this works. And you need to know, of course, it doesn't work every time. It's not a holy grail, so you need to also determine by yourself, is it worth it using. You need to test it out and see if it is useful. If it is a useful tool for you, and do you think it is good in use for your trading method? And now we are going for the next point, which is how to write bigger trends. And basically it is how to set a trailing stop based on the ATR indicator. And as you most probably know, if you watched previous videos, I am not a big fan of the trailing stop loss, but there are some use cases for it. And it is, for example, in situation like this one, when we have strategy that we are trading with 2R or 3R risk reward ratio, which is basically when we are risking 2 times or 3 times less than we can potentially gain. So in this situation, the risk reward ratio was 2R. The market fulfilled our target, and it is further strong trending upwards. Okay, so what we will do is to again take the ATR from the entry point, which was 59, and yeah, multiply that by 3, and this will be our trailing stop level. So 59, yes, 59. 59, multiply that by 3, it is 177. 177, okay, 78 it might be, it's not a big deal. So let's take it to the upside. 100, okay, 176. So it would stop. So you can see there was no major retracement, and again in this situation we could possibly be stopped out somewhere in this area, so we could gain even 3R or 4R possibly. But as I said, again, this is a cherry-picked example. It doesn't always work that beautifully. But I hope you understand what I have on mean. Yeah, explaining this this concept. And I think that is all. So basically what you need to remember from this video is that the ATR measures the volatility, and we learn how to determine the strong reversal points and the breakout moments when we are measuring the multi-year low volatility on a weekly time frame, and how to set a stop loss based on the ATR. So I think that is all for this video. Thank you for watching. Remember to subscribe to this channel and to check LiteFinance on other social media like Instagram and TikTok. I am posting stuff also over there, so be sure to follow LiteFinance over there too. And yeah, thank you for watching. Until next time, guys, take care, bye.